So, welcome everyone from the Authors Guild Foundation. We're back with Tax Tips for Authors 2025 edition. I know authors have a lot of concerns with deductions and other affairs that are a little bit different for any freelancer, and especially for someone who publishes books and earns royalties, all these very specific things. It's great to just get the lay of the land on what's most important to know and answer some of your questions. I'll go ahead and say a bit of a disclaimer. This doesn't constitute legal or tax advice. You should seek professional consultation for that. But Robert Pesce is treasurer of the Authors Guild Foundation and a veteran a CPA who specializes in helping artists and creatives. So he definitely knows his stuff. And if you watch our webinars, you know Erin Lowry of our Money Matters series. She'll be here interlocuting with Rob. I'll go ahead and turn it over now to Erin, but I also must say these programs that we do, these free public educational webinars, are thanks to the support of our donors and especially the National Endowment for the Arts. Erin, I'll let you take it from here. Thanks.
Thanks, Johnny. Hi, everyone. Welcome back. Excited to be here with Robert today. So just to tell you even a little bit more about Robert M. Pesce, he's a partner in the Tax and Business Services Division of CBIZ, formerly known as Marcum LLP, and the national partner in charge of its accounting services group. He has an outstanding reputation for developing strong relationships with clients in the entertainment industry, as well as professional services firms. His ability for successfully working with actors, authors like us, and agencies led to his instrumental role in the founding of the firm's media and entertainment group. Mr. Pesce serves as treasurer of the Authors Guild Foundation. And the other thing I want to let you know before we get started is to remind you that not only do we have previous year's tax webinars going back a few years, we also did a webinar with Robert about forming an entity when authors should create an LLC or S corporation. We always get a lot of business entity questions when it comes to these tax webinars. We'll touch briefly on a couple of things, but really, if you want more of a deep dive into those topics, please go check out that previous webinar that's available in the Authors Guild Resource Library. All right, with that being said, I also know, because I see the questions that are coming in, every year, one of the biggest questions is whether or not there has been a shift in the tax code. Is there a big change that's relevant to us as authors, particularly for those of us who do not tend to use a CPA to file our taxes? Well, I'm going to put everybody at ease by saying that Robert and I have already chatted about this, and no, there is not a big change or any big changes that we need to know about, but there is certainly still plenty to learn and refresh. So now to get started officially with Robert, one of the most common questions we had coming in was how many years can you report a loss before writing is considered a hobby rather than a business?
Okay. Well, thanks for that introduction, Erin, and thank you, Johnny, for being behind the scenes technically. Good to be here and I hope to answer all these questions that you have, and we have plenty of time for some Q&A maybe at the end also. So I think we're talking about the hobby rules. So I prepared for that today because we got a lot of questions about that every year, and I always give the same answer, but it just doesn't seem to be good enough. So I figured I'd print out the information from the IRS about this stuff, and maybe we can actually really nail it. So the hobby loss rules basically say that you have to be, first of all, you have to have an intent to be in a for-profit business. You have to have an intention to make money. You have to rely on the activity that you're doing to support you. You have to have an expertise in what you're doing. You need to have a profit for 2 out of the last 5 years. So that's the main things. It doesn't mean that you have to have, if you don't have one of those things, it's not a problem. You have you have to have as many of those circumstances in place to be able to say that you are really in business and that you're not a hobby and you're allowed to take deductions for expenses in your business. And yes, it's okay to have losses in a year or two for reasons that are appropriate, like situations that are beyond your control. Maybe when you're just starting out, you have startup costs that are greater than your revenues. These are legitimate reasons to have losses. So when I have clients that have years where they make a lot of money and some years where they make no or a little bit of money, but I have not had an issue with anybody actually violating the hobby loss rules or getting letters from the IRS challenging them as being in a hobby rather than in a for-profit business.
Thank you for that. And thank you also for referencing, we will be opening up to Q&A at the end. So if you have a clarifying question as we're going through today, or something new comes to mind towards the end, please don't hesitate to drop it in the Q&A. Now, speaking about, the hobby loss rule, I think the other big question that a lot of people have is, what does it take to be qualified as a writer when it comes to tax purposes? For example, do I have to have published a book, or do I have to be writing consistently for a well-known outlet? What does it take to be known as a writer?
According to the IRS, a writer is an individual who creates a literary manuscript, a musical composition, including accompanying words, or a dance score. That's what a writer is according to the Internal Revenue Service. So to be more practical and not just reading stuff from the IRS publications, if you make money selling an article or a story or a novella or a book or a pamphlet, you're a writer. You're a professional writer. Your income is taxable, and you're allowed to take deductions against that activity as a writer. Are you a professional writer for the long term? I guess you take it 1 year at a time, but that's the answer.
And just to further clarify, the hobby loss is, somebody had asked regarding the recording of a loss. If we have a profit for a couple of years and we have a loss the next year, is that accepted? And based on what you said about a client where some years they make a lot of money and some years not so much, that it is acceptable, I would assume, that you have a loss 1 year.
Basically, the presumption of profit, an activity is presumed to be carried on for profit if it produced a profit in at least 3 of the last 5 years.
And you mentioned pulling information from the IRS website, and I actually want to go out and endorse irs.gov. Everything is in layman's terms. It actually is an excellent tool and resource to use for really whatever tax question that you have. Just make sure you're going to the right website. It's irs.gov.gov. But they do an excellent job of giving examples and really putting things in layman's terms.
I would recommend publication 334, which is small business publication. It has a lot of things there that would be useful to you. And there's also a publication 535, business expenses. It's a lot of stuff, but when you get to the report, if you use the search feature in Adobe, you can find what you're looking for very quickly. It's very helpful. You're right, Erin. It is.
Love that. Now, I mentioned in the intro that we're not going to get deep onto business entities today, but we will talk a little bit about them. So first, is there any tax advantage of being a sole proprietor LLC?
Okay. I answered this question to somebody yesterday on the phone. It happened to be somebody who contacted me through the Authors Guild. So most people start off as sole proprietors, not as an LLC, just an individual who's reporting their income from writing on their Schedule C on their individual tax return. That's a sole proprietorship. Sometimes people decide to form an LLC. If an individual forms an LLC by themselves, that the only owner, the only member of the LLC, for tax purposes, the IRS considers the LLC to be a disregarded entity, meaning that it is the person who formed it. There's no difference tax-wise being a sole proprietor or a single member LLC. They're the one and the same for tax purposes. There's legal distinctions, but for tax purposes, no distinction.
And the legal distinction too, I would say you'd want to consult with an attorney about whether or not that makes the most sense for how your business is structured and if it's necessary for you.
Right.
So somebody wrote in and said, my accountant recommended I set up my writing business as an LLC with an S corporation designation. What are the benefits and drawbacks of this? And I'm just going to add in a little bit here. And you have mentioned in previous webinars that there can be an income, not necessarily a requirement, but benefit when it comes to structuring as an S corporation.
Yes. So we'll not go too deep into this, but people do form LLCs and then file a form. It's a one-page form where you check a box telling the IRS that you want the LLC to be treated as a corporation, and another form that tells the IRS that you want the corporation to be treated as an S corporation. If you do that, there are some advantages. The main advantage is that the income from the S corporation is not subject to self-employment tax, Social Security and Medicare. That's the advantage. So if you have a $200,000 income as an author, if you were not incorporated, if you were not if you were not incorporated or not having an LLC treated as an S corporation, everything that you make would be subject to self-employment tax. As an S corporation, the salary that you take from the S corporation is subject to Social Security and Medicare, but the portion that you don't take, that you take other than salary, is not subject. So there's an art to this. If you're making $200,000, you might take a $50,000 salary, pay Social Security and Medicare on the $50,000, and the remaining $150,000 profit is not subject to the self-employment tax. That's the advantage. The disadvantage is that you need to, the S corporation would have to file its own separate tax return, get a tax ID number, have separate bank accounts. There's administrative cost to this, but if you do it the right way and if you make enough money, the benefits will outweigh the costs. I have many clients who are successful authors who have reached the limit where it makes a lot of sense to become an S corporation, and they are.
And just something to keep in mind, if you then structure as an S corporation and you go through a down year or two, it then also becomes not necessarily a question of whether you want to release the designation, but there might be some years where it's very beneficial and some years where it's less beneficial.
That's right. When someone says, should I do it? I ask them, what are your prospects? Do you think, is it just a one-hit wonder, or are you going to be in this for the long run? Because there is an investment that you make into it. And, once you have it, you're kind of stuck with it. And so you really have to be thinking about long-term planning when you make this decision.
Now, obviously, there are plenty of authors that do have a day job on top of their work as a writer and as an author. So what are some of the considerations for those who do have a full-time W-2 job? What are some of the things they should consider when separating the taxes of being an author and being traditionally employed?
Well, I would say my answer is the same whether you have a day job or not. I would say that the best thing you can do to track your income and expenses as a writer is to have a separate bank account for that activity. Whatever you make goes into that bank account, and whatever you spend on your writing expenses come out of that account, and possibly also a credit card that you might decide is specifically used for that business as a self-employed writer. So whether you're doing that every day and don't have a day job, or you do have a day job or other sources of income, it's really helpful to have the business activity segregated from everything else.
And I could not endorse that more. As somebody who did spend time doing that exact sort of structure, definitely keep them separate, makes your life a whole heck of a lot easier.
Yes, no cherry picking.
Now, we're going to move on in a second to tools, but again, I want to reiterate, particularly for those who maybe were not tuned in at the beginning of the webinar, that we always get a lot of questions about business structures and entities. That in of itself could be an entire webinar, and it has. We have a former recording in the Authors Guild resource library entitled Forming an Entity, When Should Authors Create an LLC or S Corp? So if you have additional questions, please do check that webinar first. Going on to tools, what, Robert, do you consider some of the more appropriate tools or software to keep track of our expenses, or should we just go spreadsheet?
Okay. A lot of people have trouble with something called QuickBooks. QuickBooks as an accountant is my favorite tool for tracking your business expenses and your income. It's very professional. It's very user-friendly, but many self-employed authors don't have the time to learn it and really don't want to learn it. So for the authors that I work with that don't use QuickBooks, they basically will have their bank account, as I said before, separate bank account for their business. And at the end of the year, they'll go online and they'll download the activity to Excel and then sort it in a certain way so that things are categorized and easy to summarize for their accountant or for themselves if they're doing their own taxes. It's the most common way is to do it the way I just said. Just download your bank activity into a spreadsheet and sort it. But when I talk to an author, if they tell me they have a bookkeeper that does the stuff on QuickBooks, I'm really happy.
Anything you can do to make their lives easier. Also, getting your information in earlier on in the tax season is the next thing to do too.
Yeah, definitely. Either, you really at this point, you decide, do you want to be at the front of the line and get your taxes done now? Or if you're not in the mood, forget about doing it in late March, April. It's just too stressful for everybody. Just do an extension and you'll get this stuff done in March, in May or June.
Well, and speaking of people coming to you, what is one, two, or more things that you wish that all of your clients knew when submitting forms and information to you?
That's a good question. Well, I think it's really just being organized and complete. But sometimes the question is, what do I see? What mistakes do I see from people who are working with an accountant for the first time? People are not aware of the rules for paying quarterly estimated taxes. I feel bad for them because then there's whatever taxes due is due plus avoidable interest and penalties. So that's one thing I see. I see people who have worked with accountants prior to switching to maybe to me. They worked with an accountant who maybe was a good accountant, but wasn't a specialist in this area. So if you're going to work with an accountant, it's really important to work with somebody that is a specialist in working with authors. And when it comes to choosing a good accountant, I would basically say, as authors, as members of the Authors Guild, you should talk to your peers, your colleagues, and ask them who they're using, if they're happy with them, and if they have experience working with an accountant that specializes in authors.
Which you got jumping right to the next session about how to vet and find a CPA. So at what point in an author's career does it make sense to hire a professional instead of just using tax preparation software?
I think the most common reason is that the author has decided that they're just too busy / successful to be doing what they've been doing for years themselves, and they really want to just, kind of upgrade. And it's a quality of life issue, really, for a lot of people. They just decide that they don't have time for it anymore, and they're probably not doing it to the best advantage, and they would like to pay for somebody to do it the right way, and hopefully see the value of that, not just from a quality of life perspective, but from a tax savings perspective as well. As far as what dollar amount might that be, it really depends on the situation.
Now, you had mentioned, going to ask fellow authors about recommendations for CPAs that they use. Are there any databases or a location where you can vet to make sure that somebody is credentialed in the way that they say they are, or any option like that? Like, I know with financial advisors, you can do the FINRA broker check to make sure that they actually have the license that it says that they have.
That's a good question. If you get a name of somebody that is recommended to you, you could certainly Google them and look them up and maybe find their website or something that tells you about them. Hopefully good stuff. I would recommend, if you're going to work with somebody to do your taxes, they are a CPA. And if they are, I think there's probably a way to go to either the AICPA or the state society that they belong to as CPAs, and probably find information about them. Maybe some bad information, maybe some good information. I really don't know if it's a searchable database, but it's a really important thing to do. You definitely want to get references or get some kind of research on them to know that they are who they say they are.
Especially because you are sending all of your vulnerable personal financial information to somebody.
That's a good point. It's just if you're working with somebody, if they say, send me your tax return, and they don't offer a way to do it in a safe and encrypted way, that's a signal. That's possibly a sign that they're not really up with the times. And this is, data breaches and identity theft is no joke. And we see it all too often. So if you work with somebody who's got that casual approach to getting information back and forth, be careful. This is sensitive information about you and your finances, and you should be, taking it seriously, and so should they.
And just to reiterate for those listening, when you say a safe and encrypted way, so obviously not just sending an attachment in an email, what is an example of a safe and encrypted way?
Well, at the very least, you can always password protect a file. If it's Excel or Adobe, there's a way to do that. Our IT people at my firm don't find that to be acceptable. It's just not enough. So we actually have a link that we send to our clients that allows them to put it into that safe environment and travel through the internet to us without it being violated. It's super high encryption. I don't know the technical terms for it, but password protections at least, and encryption at best.
Absolutely agree. Moving on to deductions, always a lot of questions about deductions. So starting with, are there differences for how traditionally and self-published authors should handle their taxes, particularly around deductions?
So we're talking about the distinction between the two.
Yes.
Well, self-published authors probably have some expenses that are different or in addition to the traditional author that has a contract with the publisher that pays them royalties. So there may be some other expenses that a self-published author may have that the others don't. Not sure if I get the rest of the question, but
Well, that being kind of the big differences, are there things that maybe self-published authors should be considering for deductions that traditionally probably don't have to consider because they're not the ones having to maybe hire for cover art, hire editors? There are a
there you
lot
go.
of
Right.
there's a lot that goes into self-publishing in terms
Right, the
of how many
production
voices
costs,
are
right? The
there.
marketing, the production, the printing, all the things that could go with actually manufacturing and selling a product. That's not the case when you're a traditional author selling your copyright for royalties.
Well, and that brings us well into our next question is, do you have some specific examples of items or services that authors can deduct from the taxes? I think there can sometimes be a lot of confusion around what you can and what you can't. I will also plug irs.gov here. Again, they are pretty clear on the website.
Yeah. Schedule C, which is where a self-employed author reports their expenses, has a really good list of the things that you would deduct. So that's advertising, public relations, telephone, internet, cable, office expense, rent, health insurance, educational expenses, outsourced subcontractors, repairs and maintenance, supplies. There's all kinds of things that you have in a business that you can deduct and basically you should really just pay for the things that you think are related to your business and then get them categorized. And don't worry if they're not deductible or not. Let your accountant help you with that. But there are some things that are not deductible. So somebody was asking me the other day about dues. Dues to places like the Authors Guild are definitely deductible. But dues to places like an athletic club or a lunch club or a sporting club or an airline lounge or a business association, those are not deductible anymore. Just like entertainment's not deductible. Now, what about entertainment? Meaning if you go to a show, a Broadway show, or you go to a film, that's something I would call that media research. You're consuming information that's helping you be relevant as a creative person. But taking a friend to a basketball game, unless you're a sports writer, that's entertainment, and the current tax law does not allow that to be deducted.
We had a bunch of questions come in that were specific to writers' retreats, continuing education credits, Authors Guild dues, which you just checked all of those, but I do want to reiterate, and what you just said, those are eligible for deductions. Now, with a writer's retreat, though, if you're traveling, there is a little bit of nuance sometimes with travel and what you can deduct, especially if you maybe tack on a for pleasure trip to that business trip.
Yes, there's a lot of information about that. I consider that to be a bit subjective, but the basic things that I watch out for is, let's assume that you're taking a trip to a writer's retreat, a book fair, or something that's relevant to you as a business person in the writing business. The airline tickets for yourself and the hotel accommodations for yourself for the days that you're there for the event would be deductible. If you're bringing somebody with you that has nothing to do with your business as a writer, a significant other, I would not deduct the cost of their airline ticket. I'd be comfortable taking the cost of the hotel room because you need a hotel room, whether they're in the room with you or not. That's not the IRS's business. And then as far as meals are concerned, meals during the event, I think are deductible. But if you have your friend or significant other join you, you probably should only expense the part that is for you to be appropriate. But that's basically the answer on that. Travel is if it's ordinary and necessary for your business as a writer, it's a good deduction.
Now, when it comes to legitimizing deductions, is a receipt enough for doing that, or do you need more paperwork?
Well, to document to support the existence of the expense, whether it's a travel expense or purchase of a notebook, a receipt or a credit card statement, if you use the credit card, which is a popular way of doing things, is really sufficient to document the existence of the expense.
And when it comes to being able to claim deductions, one of the questions that came in was, can a traditionally published author that has received one very modest royalty check from their publisher claim business expenses? So to make that a bit more broad, we talked about loss, like hobby loss rules. At what point you're like, hey, I'm a legitimate writer, author, I can claim deductions?
Right. So if you have a history of being a legitimate for-profit author, and over time that has kind of dwindled down, and maybe you had a loss last year or the year before, or maybe both, and now you're back in the game. You got a new book contract, you got a new advance. You definitely would take the deductions, continue to report your activity as a writer, and take the deductions. Sometimes authors have very little income and have a lot of expenses associated with something that they're still creating. And the question is, can I deduct those expenses now, even though I haven't received the compensation for what I'm creating because it hasn't been published yet? And the answer is yes. You can deduct the cost of these expenses that are associated with developing what you're writing, as long as you believe that it's going to be eventually submitted successfully and published. Now, what do you know? We can't be sure of these things, but we have intentions and we have belief that that's the case. Certainly, if you have a contract, if you have a contract that says that they're going to let you write it and hopefully accept the manuscript, that's definitely good evidence. But the intention is really what matters. And some people would rather not deduct them and capitalize them and carry them forward to the year that they're going to have the income. You can do that too.
So great that you mentioned that, because a question came in that was very specific about that timeline. This particular author is working on their debut novel, and they had spent 5 years writing the book and getting the publishing contract. And their CPA had advised them to just keep track of the writing expenses to carry it forward for when the revenue was actually relevant. However, they heard at a different conference that you can only carry it forward for 3 years prior to revenue. Is there a time limit?
Not aware of that rule. It may be correct, but I don't know that rule.
Okay. I'm going to say go to the website on that one. And also going back to the folks who are hybrid, who are traditionally employed but have a writing business on the side, what is a great strategy for them to, or should they even bother, is maybe also how I would phrase this, having a deduction for the side business when they also just are going through a traditional W-2 tax return?
Well, if they have a day job that's successful and really sustains them day to day, but they are actually a writer that they have, again, intention to be profitable, it's something that they do, that they rely on some of that income to help them, to support them, they should be reporting. First of all, you have to report your income. You have no choice. You have to report your income. So if you're going to report your income and you have expenses associated with it, and those expenses are tax deductible, I don't know why you wouldn't deduct them.
Agreed. On to royalties and income and grants. Why is it that royalties are reported on a separate form from a Schedule C?
Okay, so there's a form, Schedule C, which is the form that self-employed people report their income and expenses. And there's a form called Schedule E, which is for rents and royalties. So before, somebody asked me, what's a big mistake that you see authors make sometimes? From time to time, I will see an author reporting their royalties as a writer on Schedule E because it says Schedule E is for rents and royalties. But your royalties that you earn as a self-employed author go on Schedule C. They are subject to regular income taxes and self-employment taxes. The royalties that are talked about on Schedule E are royalties for things like oil and gas royalties and things like that have nothing to do with being self-employed. So if you're self-employed and you're not incorporated, your income and expenses as an author go on Schedule C, not Schedule E.
Oh, that's a great clarification. And to further reiterate, so are royalties taxed as regular income, or is there a different rate on royalties?
So royalties are taxed as regular income, the same way wages are taxed and the same way that freelance income from consulting is taxed. However, in addition to the regular federal and state income taxes that would be applicable, you have to pay self-employment tax, which is again, which is Social Security and Medicare on your self-employment income.
Now, obviously, sometimes authors can have income and book sales that are happening internationally. So what are you supposed to do if you receive what's called an NR4 from a Canadian-based company? I assume their version of a 1099. If we get documents from foreign companies, do we report that on our US-based taxes? How does that work?
Okay, so I'm glad you didn't ask me if you have to report it in Canada or wherever it's coming from. But we are all required to report our worldwide income on wherever we make in our US and state tax returns. That being said, if traditional authors have a contract for their foreign rights to be published outside of the United States, generally, again, you're going to report that income on your US tax return, but sometimes there will be foreign taxes that were withheld from that income. And so one of the things I see sometimes when I work with an author for the first time, they tell me that they made $10,000. I ask them for the 1099. There's a 1099 that says they made $10,000. Then I ask them if I can get a report from their literary agent that shows how that $10,000 breaks down. And we find that there were taxes withheld at the source. And so instead of reporting the $10,000 that was net paid to the author, it's probably better to report the $11,000 that was payable to the author and take a credit for the $1,000 that was paid in taxes to the foreign country. The tax credit is a dollar for dollar reduction of your federal income taxes. So instead of paying taxes on 10, you pay taxes on 11 and get a $1,000 credit for the taxes that you paid. It's a lot better.
Just to jump down to actually a future question, is that related to the 6166 certification for foreign rights?
It is.
Okay.
It is. So people will get an opportunity to file a 6166 form, which is a certification of being a US taxpayer. And the foreign publisher wants that so that it allows them to take advantage of whatever treaties exist between their country and the United States, and thus withhold the lowest or least amount of taxes allowed if they have the proof that you are a US taxpayer. That's why people fill out the forms. If you don't fill out the form, then they take the most taxes they're allowed to take out, and then you get the credit anyway and get the money back ultimately. But better to get more in your check than wait for the government to give it to you in a tax refund.
And I just want to reiterate right here that this is why it's helpful to go to a CPA who has very specific knowledge of authors specifically, as opposed to just generally how to deal with self-employed people. So just want to point that out. Now, I know I have personally dealt with this. What happens if a client or an organization does not send you a 1099? For example, if you were awarded a writing grant or you rendered some sort of services, is it necessary to report those funds? Yes. And if so, how do I do it if I don't have the documentation?
Okay. So they're supposed to, whoever pays you is supposed to report it on a 1099 to you. If they don't, that's their problem. We are all required to report our income. This is an honor system. We're required to record our income and report it on the appropriate tax forms. In the case of getting a grant or something to do with your work as a writer, if you got paid $1,000 and you know you got paid $1,000, it was deposited into your bank account, that's all the information that you need to justify and require you to report it on your tax return. The fact that you didn't get a 1099 does not absolve you of the responsibility of reporting the income on your tax return.
Now, is there a threshold, a minimum amount until we're required to report income?
Yes, I think it's $400.
So just report is really the easiest thing here. If somebody received book royalties for the year 2024, but that payment was actually rendered, let's say January 1st of 2025, is that income counted in 2024 or 2025?
Most authors are cash basis taxpayers. So you report your income when you receive it, not when it's earned. So that's the short answer. Sometimes you'll get the money in your bank account on the 1st or 2nd of January, and the person who paid you wrote the check, the disbursement in December, and considers it to be a in this case, 2024 expense for them, and report it to you on a 2024 1099. There's a little bit of a conversation there, but you're probably going to end up reporting it as 2024 income. It just didn't hit your bank account until the next day or the day after. But the general answer is cash basis taxpayers report the income when they receive it, not when it's earned.
Now, I want to go back to the discussion we were having about royalties and the fact that that is considered income and the Schedule E is not relevant for our royalties. It's a different kind of royalties. But is royalty income eligible to be contributed to a retirement account like a SEP IRA or a solo 401k, or is that not considered an earned wage?
I don't think it's allowed to be contributed. However, as a self-employed author who's reporting their income on Schedule C and paying taxes and self-employment taxes, that income qualifies you to contribute to a tax-deductible or Roth IRA or a SEP or any other type of retirement plan. Yes. So
Okay.
if the question was, can the source be paid to the plan? No. But if you're getting paid and you're earning money as a self-employed author, it does qualify you to contribute to retirement plans such as IRAs and SEPs.
Great. Moving on to sales tax. With more authors doing direct selling via online storefronts, what are some of the must-do tax things that are unique to e-commerce business? For example, including sales tax in a multitude of states.
Yeah. If you're selling online and you're obligated to collect and remit sales tax, I would recommend using a platform that does that for you, like Shopify or some of these other places that do this for you. You do not want to get involved in registering with every state that you sell something in and having to figure out the laws and rules and file the sales tax returns that go with it. It's a big headache. So if you're going to be an online seller, make sure you use a platform that takes care of this stuff for you and you don't have to think about it. It's very onerous, in my opinion.
Agreed, for sure. And if you have a novel that's published in a different country, for simplicity, let's say your novel's published in Canada, but you live in the United States, are you paying taxes to both countries?
Well, you might be. And if you are, you'll get a credit for the taxes you pay to Canada on your US tax return. So ultimately you'll be paying taxes once. But remember, if you have a contract, you're collecting royalties. You're not selling books anywhere. You're collecting royalties on your copyright. So it's possible that the revenue that you're earning from the Canadian publisher is not taxable in Canada. It might not be, but if it is, the answer is you only pay taxes net one time, even though it might be going to two different governments.
All right. Now, we did talk a little bit about quarterly estimated taxes earlier, but I do want to make sure to really dig into this topic so there's a lot of clarity for folks. Can you first just explain who needs to pay quarterly estimated taxes?
Yeah. Yes. So we're all supposed to pay our taxes as we earn our income. The government doesn't want to wait a whole year for their taxes. So the most common way of earning and paying taxes is through wages. You get paid on Friday, the employer takes the taxes out, remits it to the government, everybody's happy. Maybe not us getting a small net paycheck, but the government gets their taxes the way they're supposed to get it. If you're self-employed, you're getting your income and the government's not getting their share of the taxes until you pay it to them. So they have a way of getting their money in this situation. They call it estimated quarterly taxes. So we're supposed to pay quarterly taxes. We're supposed to calculate what our taxes should be 4 times a year: April 15th, June 15th, September 15th, and January 15th. January 15th is the 4th installment. How do you figure out what to pay? There's 2 ways to figure it out. Assuming that everybody in the call would like to pay the least amount possible, you pick the lower of these 2 choices. If it's your first year, you're going to basically pay taxes based on what you are earning and figure out what the taxes are, estimate what the taxes are on that, and pay it in quarterly installments. So in quarter number 1, you make $1,000, you should pay, let's just say, $200 to the government. So you do that. And next quarter is the same thing, same thing. So you paid taxes 4 times. You made $4,000. You paid $800 in taxes. You should probably be okay. Hopefully you are. Next year, you make $100,000. Wow. You have a way, you can either pay the prior year's tax, 110% of the prior year's tax, and be allowed to owe whatever's due at the end of that year without any interest or penalty, or you can pay the taxes on the actual income that you're earning. It's actually 90% of the income that you're actually earning. So you have a choice. Pay 110% of the prior year's tax, which in my example before would be it's $880, and be allowed to be protected by the safe harbor rule and be allowed to owe whatever taxes you owe on that big income in the following April without any interest or penalty. So that's basically it. It's either 90% of your current year's tax or 110% of the prior year's tax. Obviously, if you have a really good year last year and you have a down year this year, you're not going to use the 110% rule because you can be overpaying.
When it comes to actually setting aside money for quarterly estimated taxes, particularly if you're just not sure what each quarter is going to look like, what do you recommend doing? Do you have a rule of thumb?
Yeah, I do. So besides the rule of thumb, the way of doing it outside of a rule of thumb would be to understand what tax bracket you're in. But if you don't know what tax bracket you're in and you just want to use the rule of thumb, I tell my clients, take a third of what you're receiving and put it into a separate bank account, or make sure that you keep track of how much that is going to be eventually payable. A third, I think, is a good number. It may not be the right number, but it's close enough. That's my rule of thumb.
I will second that. I love separating that way, particularly when I was structured to pay quarterly estimated. And you can usually nickname a bank account, and
Yep.
I would nickname it something like Uncle Sam's money or tax money, just to really make sure your brain remembers what it's for. And just an additional bonus tip, if you want to make sure you have money set aside to contribute to a retirement account, you can even up the amount that you're setting aside out of each paycheck, and then what is remaining after quarterly estimated, you can dump into a SEP IRA, solo 401k, Roth IRA, traditional IRA, et cetera, et cetera.
That's a really good idea. I have clients who think that way and it works for them. We figured out a percentage for taxes and for retirement. They put it into that account every time they got paid. And whenever we had to pay money for taxes or contribute to the retirement plan, they never felt it. It was great. Now, if we didn't do it right and they had to go into their regular money, they'd be upset.
Yep. There is a small risk, but it's nice to have money set aside for sure.
Yeah.
Now, you had mentioned earlier, obviously, the government wants its money throughout the year, not just waiting till the end, but sometimes people screw up, and maybe they're traditionally employed and didn't realize they need to also pay quarterly estimated taxes on their self-employment income that's coming in. Maybe it's your first year and you didn't realize you needed to do that, and a penalty is coming.
Yeah.
So how severe are we talking about with a penalty? And for folks who just don't want a deal, is it ever worth it to just take the penalty at the end of the year instead of paying the quarterly estimated taxes?
It could be. The penalty is a scary word. It's not, you're not going to get whipped or anything. It's just, it's a fee. And roughly the fee is about 5% of what you owe. That's roughly the number. If you pay your taxes by April 15th, but you didn't comply with the quarterly estimated tax penalty, quarterly estimated tax rules, the consequence is about 5% of what you owe. Now, different question, if you don't pay your taxes by April 15th and you pay them after April 15th because you didn't have the money or because you didn't know, the penalty gets a little bit more expensive. It goes from 5% to much higher than that. So make sure you pay your taxes by April 15th. If you can't pay them quarterly, make sure you at least pay them with the return on April 15th or valid extension by April 15th. But it's just a fee. It's a 5%, roughly on an annualized basis, about 5%.
Is there a certain amount of income that you need to be making before it kind of triggers needing to pay quarterly estimated taxes?
The answer is yes. I don't know what that low threshold is, but there has to be a bottom number, yes.
And for folks who are married and file a tax return with their spouse, maybe their spouse is traditionally employed, the understanding is that they do still need to be paying quarterly estimated taxes, even if they're filing a tax return with a spouse who has a W-2.
That's right. So the spouse has wages with W-2 wages and taxes withheld. And hopefully, let's suppose the taxes withheld are exactly what they should be to support the income on that W-2. Your income as a self-employed writer has to be factored into the overall situation. And, it might be that your spouse makes more money than you do as a writer, and your joint income puts you in a higher tax bracket than you might be separately. So that's something to look at also. But you have to figure out what your taxes are as a family, what the taxes would be on your joint income, what those taxes are minus what was withheld from your spouse's wages. And the net result is what is payable, either quarterly or with the return.
And on that notion, then it probably can make sense sometimes for your W-2 spouse to maybe change their withholdings to better account for what you should be paying throughout the year, particularly if you have a really good year as a self-employed person.
That could be a good strategy. If your spouse is willing to up their withholding to pay some of the taxes that you should be paying quarterly, if that's how you guys look at it as a family, it's all one pot. That's a great idea. It's a great way to do it. It solves the issue of having to file estimated quarterly taxes.
So one person asked, I have a full-time job for which they receive W-2 and pay taxes in addition to their quote minimal income as an author. When they report that author income, they do have to pay self-employment tax on that income as well, or do they not?
So there's a limit. The limit to paying Social Security or the Social Security portion of self-employment tax, I think the income is about $170,000 this year. So if you have a day job and your compensation is let's say you make a $200,000 salary, your salary has put you over the threshold where you're subject to Social Security. So the self-employment tax that you pay on your self-employment tax on your self-employment income would only be the Medicare portion of the self-employment tax. Self-employment tax is basically Social Security and Medicare. Social Security piece is 6.2% times 2 because you're paying both sides of it as a self-employed person. And the Medicare tax is 1.45% times 2. So if your wages put you over the Social Security limit, you're only going to be paying the Medicare portion of self-employment tax, which is 2.9%, 1.45 times 2.
All right, and we're gonna do a couple of little niche questions, and then, I've been pulling your Q&As, but please, if you have more, feel free to pop them in right now. I'll be pulling some more to ask Robert here in our last, 10, 12 minutes with each other. But we had actually this year quite a few questions come in preemptively about US citizens living abroad. I know this is a very general question, but what are some of the tax considerations for folks who either do live abroad or who are planning to move abroad?
I think the number one thing to be aware of is the foreign earned income exclusion. If you satisfy certain rules and you have to be there a certain number of days, I think it's 330 days, that there's certain rules that would allow you to take advantage of something called the foreign earned income exclusion. And it allows you to exclude a significant amount of your income from US taxes. It's over $100,000. It changes every year with inflation. So foreign earned income exclusion, a very important thing to be aware of if you're living abroad and working abroad.
All right. And so going into some more questions that have been filtering in throughout our chat today, what are an author's obligation for reporting payments and sending 1099 to people that they have hired, such as a cover art designer or an editor?
Yeah. So 1099s are due actually tomorrow, Friday, for 2024. And you're required to report any income that you paid to an unincorporated entity for services they rendered in excess of $600. So if you're a graphic person is doing work for you and they're not incorporated, you're required to issue a 1099 to them if you paid them anything more than $600. If they have a corporation, you're not required. Now, some of you might be aware of something called a W-9, which is what you give your literary agent or publisher so that they have the information that they need to properly 1099 you. If you're paying somebody for services that they're rendering to you as your business as a writer, you should get a W-9 from them before you pay them so that you have their name, their address, and their social security number so that you can give them the 1099 that you're supposed to give them without having to track them down in January.
Now, we have quite a few attendees who either are currently taking Social Security or are nearing the time to take Social Security. So are there any tax tips specifically for authors who are on Social Security?
Well, I would just say that Social Security is taxable depending on how much your overall income is, and the amount that it is taxable depends on how much you earn. So just be aware of that concept, and if you can, maybe you want to time your income. So maybe if you're supposed to get an advance, you find out about this advance coming to you in November, and you have an option to take the money in January instead of November, and maybe taking it in January causes your income to be below the threshold where your Social Security would be more taxed. There's a strategy there to take. That's basically the first thing that comes to mind.
All right. I do want to go back to clarify something on the 1099 that you have to send to other people. A clarifying question came in. The $600, is that a one-time payment or collectively throughout the year? If you've paid somebody $600, you distribute a
Good
1099?
question. If the total amount that you paid to a specific unincorporated entity is in excess of $600, it's reported on a 1099.
All right. Now, this is a specific question, but I feel like it can be broadened out. Can novels bought for study in your genre count as a deductible reference material? But we can also kind of broaden that out to whatever your genre is. If you are purchasing books to read, either for your own education or to kind of, maybe check out the competition, is that a deduction?
Yes.
All right, nice and easy. I spent nearly $100,000 on my new book, which is not living up to expectation in sales. They are weak. Is this a red flag for an audit? And I just want to also say we've had quite a few what is a red flag for an audit kind of questions.
Depending on the circumstances, I would take the deduction if this is what happened. I would tell you that statistically, 2% of tax returns are audited. Last time I checked, 2% of tax returns are audited in general. If you file Schedule C, the chances of being audited are higher than 2%. How much more, I don't know. And if you file a Schedule C that has a very small income and a large expense, the chances of it getting audited or an inquiry or letter coming to you is there. But I can't tell you the percentage of chances of that happening. But if this is a legitimate situation, it's a choice you make. Depends on how well you sleep at night. But I would tell you that if it's defendable and you can relax and not worry about it, you should take advantage of the laws that are applicable and take the deduction.
We have one more clarifying 1099 question, which is, do you need to send it to someone if they live in a foreign country?
Oh, okay. So if they are not a U.S. taxpayer and they do not live in the United States and they performed whatever services that they did for you in that country and not inside the United States, then there's no form to give to them. Nothing.
All right. Now, I think this is an interesting question because it kind of ties back to the sales tax on selling books and it being a nightmare to register with individual states. But for authors who also then get into speaking engagement, this particular person said, I speak on topics I write about and I have to pay taxes in many states each year where the work took place. A group of speakers and authors I belong to got into a heated argument about whether or not state taxes are due on speaking engagement earnings in that state.
Okay.
Are they or aren't they?
So I think the question is about state income tax, not state sales tax.
Correct.
So, right. So if you are earning income for speaking outside of your resident state, that income is technically reportable in that state as a non-resident. The taxes on that income is whatever it is, and then you're able to take a credit for those taxes that you paid to that other state on your resident state tax return.
And my understanding, to further clarify, since Zoom is such a common way that we also can render speaking engagements now, that even if the conference or the school is in a different state, but if you are still staying in your home state and you are rendering it on Zoom, that does not count as rendering the services in that state.
I would think that's correct. I've not heard anybody tell me otherwise. The rule that we understand is that if you're physically inside the state doing the work, doing it virtually, at this point, I don't think the government's come up with any ideas on how to tax that yet, but we'll see.
I'm sure they will. All right. And then we also have my income is from 2 different freelance businesses for which I am the sole proprietor. I use the same office for both, share the same basic equipment and supplies, and lump income. Are there any pitfalls of this strategy, or is this person legally obligated to separate things for taxes?
I don't think there's any legal obligation to separate them. I think it just do whatever's convenient. As long as cumulatively you're putting it all on your tax return, I think you're good.
All right. And following up on the speaking question, I will be speaking in multiple locations in the Midwest for my book, and I'm a non-resident of the Midwest. So what do I do exactly in terms of how to render the money that you would need to as state income tax for that state?
Assuming that the Speakers Bureau, whoever's paying you, does not withhold taxes at the source, it's up to you to do what the right thing is, and the right thing would be to report on a Illinois tax return the income that you earned in that state as a non-resident, and file and pay the taxes that were due on that portion of your income. And then whatever that tax was, you take that tax and credit it on your resident tax return. That's what you're supposed to do. There's de minimis rules, there's practicality rules, there's lots of things that go along with this, but that's what you're supposed to do.
Do you have to send your agent a 1099 for their commission?
No.
And can you clarify why?
Because I don't think it's required. I think there's specific information in the 1099 rules that say that you don't have to do that.
Awesome.
And the 1099 that they give you should be on the gross that they should have paid you,
right,
rather than the net.
All right. And then for folks who like to work, not in a home office necessarily, but for instance, at a coffee shop, if you are rendering your work there, taking meetings there, obviously you can't write the coffee shop off as an office space, but could you write off your coffee or your scone or the things that you're consuming while you're there?
I would.
Okay, great. Well, this has been so helpful and so wonderful. I know we have had so many more questions come in. Unfortunately, it's just not possible to get to every single tax question that comes in during these. But I do want to reiterate, you can go back and check previous webinars. We do try to diversify the questions. So maybe a question you proposed today has been answered in 2024, 2024, 2023, et cetera, et cetera. And in addition to, don't forget to check out the business entities webinar that is in the Authors Guild resource library. There also are a bunch of resources in there talking about how to navigate handling variable income, structuring, setting up, putting your money separate from personal and professional, and how we can navigate all of this. So hopefully this has been helpful. Robert, thank you so much for joining us today.
You're welcome. Thanks for asking me to do this. I love doing it, and I appreciate the chance, and I hope I see you again next year.
Absolutely.